Hello and welcome to Market Domination. I'm Josh Lipton alongside Alexandra Canal. Live from our NYC headquarters, we're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
That's right, Josh. From today's top investing stories to Yahoo Finance's trending tickers to the macroeconomic forces shaping markets, we'll dig deeper into everything you need to know for the last hour of trading.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Look, when you're 90% of the market and you're way ahead of everybody, you're basically competing with yourself. That's what they're doing right now, is they're competing with themselves, pushing themselves forward.
We learned a lot of things at the conference, and I think the most important piece is that Nvidia is no longer just a chip company. If you look at all their extensions, they're focused on the next layer, which is really that getting that chip extended out into the ecosystem, and then of course focusing on software, which is really important for them going forward.
The most important thing that I think Jay Powell will try to do coming out of the meeting is keep his options open and keep the Fed's options open. I don't think he wants to be boxed into any particular month or action, but he wants to leave the options open that if they want to act in June, they can, but also they reserve the right to kick the can a little bit beyond June.
Looking at 2024 as this pivot year, where we come out of the high interest rate environment. Hopefully we'll see some of those Fed rate cuts through the course of this year, but really demand starting to come back. And of course, our members are ready to respond by building more homes and apartments.
We've got 1 hour to go here until the market close. Let's get you up to speed on all of today's market actions. So got some green on the screen here. Stocks are moving higher. Dow's up about 240 points. S&P 500 is up about 0.4%. See the tech-heavy Nasdaq in third here, up about 0.3%. Helping out today, by the way, is Nvidia and its new chips. They didn't actually start out in the red, but now you can see it rebounding into the green. And of course, we are waiting for that hotly anticipated Fed decision as well. Let's take a look at Treasury yields as well, dipping broadly, and that, of course, is helping stocks in today's trade. I'm just looking at the yield on the benchmark 10-year at about 4.29 here. And finally, let's have a look at Bitcoin, because that is extending a retreat, cooling here since last week's record of more than 73,000. Reports knowing that Grayscale Bitcoin Trust, the biggest ETF for the token, did post its biggest daily outflow. Now over to you, Allie. What's a big stock on your radar?
Hi, Josh. Yeah, I'm watching shares of Nordstrom. The stock is popping today, up about 9% as the founding family of the retailer looks to take the company private. That's according to a new report from Reuters. Reuters saying Nordstrom asked Morgan Stanley and Centerview Partners to reach out and gauge the interest from private equity firms for a potential deal. Although it's still possible a deal could not happen, it is worth noting that a similar effort was made from Nordstrom in 2018, and that was unsuccessful. Of course, this all comes as U.S. retailers are grappling with consumers being a little bit more selective in their spending amid sticky inflation and high interest rates. We'll be keeping an eye on Nordstrom to see how the story unfolds. But for now, we're heading back to the studio where Yahoo Finance's Josh Schaefer is taking a look at the latest sector action. So, Josh, what are you seeing today?
Hey, Allie. Yes, as Josh highlighted, we are broadly up across the board as far as the majors go. And now we have a look at the sectors. You can see energy leading today, followed by utilities. A couple of our laggards here, we're looking at real estate. And then I also want to take a closer look at communication services because, yes, lagging a little bit today. But when you zoom out, we remember we had that big jump up yesterday. So over the last 5 days, still not necessarily down. But guys, the one thing I want to highlight here with the sectors going into tomorrow's Fed meeting is just zooming out a little bit and taking a broader look here. So if we look at the year to date on the sectors, you can see communication services, tech were among some of the big winners so far year to date. But when we zoom in closer over the last month, it's been a little bit of a different story. So now you see tech down lower here, communication services down lower here, and what we've seen is a rise in materials, a rise in energy. Mike Wilson over at Morgan Stanley highlighted this as maybe investors seeing pretty expensive stocks here in tech, pretty expensive stocks here in communication services, so they went to some of those less loved sectors like energy, like materials. I'm curious to see what we get post-Fed tomorrow when we do hear a little bit more on the interest rate path, where this starts to play out. And if we keep seeing this broadening trade that we've seen with energy and materials taking over, if we see a rotation back into tech, Or perhaps, guys, if we hear higher for longer, maybe we just see a little bit more red on the screen.
All right, Josh, we'll be watching. Thank you. Stocks higher today as investors await tomorrow's Federal Reserve decision. With markets widely expecting the Fed to keep rates higher, the focus is on the dot plot. For more on how this could shake up the markets and the best way to be positioned amid a patient Fed, let's welcome in Brad Newman, Alger Director of Market Strategy. Brad, it's always good to see you.
Thanks for having me.
So tomorrow, Brad, what's going to be your focus? Is it the dot plot, the balance sheet, Jay Powell's rhetoric? What are you expecting?
Well, I think most people are going to be focused on the projections that the Fed has going forward. Whether it's 3 cuts this year or 2 cuts, there's certainly a risk that it becomes 2 cuts. And also whether the rates projections are higher in the future. So I think there's a decent chance that the longer run projection of interest rates may move higher, because I think it seems clear that what we thought was neutral probably has to be a little bit higher to put more of a dent in the economy, because the economy's been so resilient.
So let's say we do get those projections in and we only have 1 or 2 cuts forecasted for the rest of this year. How do you think markets are going to react to that? Because we've largely seen markets pretty consistent in pricing in 3 rate cuts.
I don't think there's going to be a dramatic move. 1 cut would be a bigger surprise, and that would, I think, be negative. But the market has shrugged off since late last year. They were expecting nearly 7 cuts, and now we're down to 2 to 3. So, and the market's digested that quite well, buffeted by enthusiasm for artificial intelligence. So I'm not expecting a huge reaction to something where it just tilts into 2 cuts instead of 3.
Brad, does the Fed need to cut for the market to move higher? That was a storyline, a narrative. You think that's still the case?
I think ultimately rates coming down is helpful. I mean, longer term, I think earnings can grow even if rates stay, broadly where they are, and I think the market could probably move higher. But certainly, rates coming down is what's expected, and I think what's needed for the next leg and kind of the short and intermediate term. And I think as rates move down, that's going to cause a change in market internals and dynamics within the equity market.
Brad, there has been a lot of talk when it comes to a no landing versus soft landing scenario. Considering where we're at with interest rates, where we're at with inflation, which camp are you ultimately in right now?
I think that the economy will weaken a little bit from here, but recession seems like it's off the table now. You saw housing starts being reported. The housing market seems to have bottomed and has been coming back. And manufacturing even may be coming back to some extent, and that leaves the consumer, and the consumer's proven awfully resilient.
There seems, Brad, to be this kind of growing chorus that maybe we're due here for a pullback, call it 5 to 10%. If you saw that, Brad, would you be a buyer on that weakness?
Well, I think there are some very attractive parts of the stock market right now, particularly the stocks that have gotten beaten up by rising interest rates. So, we've seen a very high negative correlation with small cap stocks, small cap growth in particular, and interest rates. It's been like a negative 85% correlation over the past few years. And they've gotten extremely cheap. They used to trade at historically kind of like a 10% premium to the broad market. Today, small cap growth stocks are trading at like a 20% discount on a price to earnings basis. So that area of the stock market seems to present some attractive opportunities in my view.
So bullish on small caps, and we have seen this pullback more broadly in the Magnificent Seven. What other areas of the market do you think there are opportunities when we look down the line and where the Fed could potentially move?
Well, when I was on the program in early 2023, we talked about AI and the infrastructure AI plays there, like hardware, Nvidia, and software, Microsoft. And then when I was on late last year, kind of broadened that out because there was a lot of enthusiasm for AI, and we talked about kind of tertiary AI plays like power and those kinds of things. And now we still like AI, certainly for the long term, but the sentiment is fairly robust there. And so I'd be looking at some other themes.
What, Brad? What would be on your radar?
Yeah, like alternative asset managers. So here I'm talking about the public equities of companies that invest in private equity. And the case for these stocks is that institutions like pensions and endowments have like a 20 to 30% of their allocation into privates, but the mass affluent in this country have about a 3% allocation. In fact, just recently, this week, CalPERS announced they were going to 40% private markets allocation. But anyway, every move from that 3% up, like if they went from 3 to 4% for within the retail market, that would be like a 15% growth in AUM for this market. So I think there's a big growth potential for the likes of Hamilton Lane and Stepstone. They've made some really good innovations. They've allowed they've allowed retail to get into the private market with much lower minimums than we typically see, like $50,000 type minimums, and also having monthly liquidity. So I think those innovations may open up the retail market to private equity, and that could be a boon for those types of stocks.
What about, besides AI, certainly one of the hottest trends investors are focused on, pharma. I'm just interested, any kind of examples there? I think there were small, maybe, and large cap names, Brad, you were interested in?
Well, of course, we think GLP-1 is going to extend its indications for use for different potential disease states. And so, we own Eli Lilly and abroad, Novo Nordisk. So still think that's an interesting play longer term, yeah.
And when we think about risks to the market longer term, obviously outside of inflation and what the Fed does with interest rates, we have the election cycle coming up. Do you expect that we'll see any more volatility as we head closer into November?
Yeah, historically, the market gets nervous leading up to the election and then begins to do well post the election. So I could envision some turbulence, particularly as more gets to be known about potential policies. But what we've published in the data that we've seen historically is that what the market envisions as being the beneficiaries from different policy moves don't really come to fruition. So, for instance, when Trump was elected back in 2016, a lot of people thought that the lowering of corporate tax rate would benefit kind of domestically oriented companies. And they did well for a little while, but ultimately, kind of over the 1 and 2 years post the election, they actually lagged. And what we did see well was innovative companies, types of companies that Alger invests in. Similarly, after Biden was elected, people thought that solar would do really well. Obviously, he ran on kind of an environmental forward type policy. And those stocks initially were very strong out of the gate and then began to underperform and didn't really have a lot in the tank over the medium term there. So again, innovative stocks outperform. So at Alger, we set our focus really on innovation and who's going to win from that innovation within industries rather than betting on policy changes.
All right, makes sense. Brad, thanks as always for joining us. Appreciate it.
Thanks for having me.
We're just getting started here on market domination coming up. Nvidia shares, they're getting back some recent losses from earlier today as investors react to the unveiling of the B200 Blackwell chip. We'll speak to an analyst on the other side about what's next for the Magnificent Seven stock. Plus crypto tanking today, and right alongside with it, MicroStrategy. We're checking on some of today's top trending tickers later in the hour. Stay tuned, more market domination still to come.
Time now for our call of the day, and Wall Street has some positive vibes for Nvidia as it continues its second day of the GTC conference. CEO Jensen Huang revealed the company's newest and most powerful chip, saying it will cost between $30,000 to $40,000. Management has hinted that there's more products in the pipeline for 2024. And Josh, all that hype has translated to a lot of these banks, Wall Street firms raising their price targets across the board. We have Goldman Sachs, Wells Fargo, Morgan Stanley, JP Morgan, all upping those PTs on the stock. Bernstein even quoted the one and only Taylor Swift, or at least referenced Taylor Swift, writing, quote, "Move over, Taylor. You're not the only one that can sell out a stadium." And a lot of these analyst notes, just parsing through them, they really focused on the rollout of Blackwell and how this chip is ultimately unmatched. The competitive angle is another one I noticed. There's just no competitor currently on the market that can even seem to match NVIDIA's cadence. And obviously the AI hype that we've been hearing about over and over again, just a continued story here.
Yeah, I mean, this stock has been such a monster. I mean, interesting kind of, we were talking off camera about kind of the price action. It was in the red, now reversing course. Now it's kind of back to the flat line. Competing headlines, maybe having some play there. But of course, also, pull back the chart, up about 80% already this year. Wall Street loves this name. I mean, they continue to. Nearly 90% of analysts think you should buy NVIDIA even at these levels. I mean, you rarely see that kind of optimism, Allie, on the street. I think one kind of theme in the notes was what Jensen Huang was saying on stage. He was kind of pounding home this theme that, listen, we are a chip giant, but we're a lot more than that. He was kind of focusing on the software and networking, making this argument, I think, that, listen, we are a platform, right? And bulls love that. And you saw that through the notes today. Some analysts saying, listen, they looked at an ecosystem and they argued it's just unmatched in this point and kind of hard to stand against. You mentioned Bernstein's Stacey Rasgon. That's what he was talking about when he reiterated that outperform rating. His target's still 1,000.
Yeah, ecosystem, really a big focus here. Chips, software, networking, that's all increasingly important to investors. So I think it's just a continued story that we'll have to be watching. But for all the positivity on the street, this stock is up very slightly. Shares were down nearly 4% earlier in today's session. So here to make sense of the moves, let's bring in Patrick Moorhead, More Insights and Strategy CEO and Chief Analyst, who's at the conference right now in San Jose. Patrick, thanks so much for joining us. I first want to ask about this price action. Why do you think we're not seeing those levels rise? Is it a bit of investor confusion? Did we see some sell the news events? Walk us through your thesis there.
Yeah, I think investors would have expected to see a knockout blow. And what I think NVIDIA brought to the surface was very compelling, particularly their embracing and extending on the platform. But there's just a lot more analysis that needs to go on. For instance, this new chip, this new platform comes out the end of the year. It's being compared to a product that that's actually shipping now. So I think what people are trying to wrap their heads around is, what can we expect from AMD? What can we expect from Intel? And how does this line up? I think they're also comparing the recent run-up that, quite frankly, is in the stratosphere. And I think what's already baked in is businesses that NVIDIA might not already command and conquer, like the CPU market. So I think there's analysis going on.
And Patrick, one piece of analysis I want to get your take on is just talk about price here for a second, because maybe a bit of confusion here, Patrick. So chips in the Hopper line, they go for somewhere between 30,000 and 40,000, Patrick. And it seemed like CEO Jensen Huang on another network today was suggesting, okay, Blackwell chips are going to be maybe in a similar range, but then apparently clarified that comment, Patrick, said prices are going to vary. Any more color or insight you can tell us about price here, Patrick, and what that would mean for margins looking ahead?
Yeah, so this new chip is actually two chips stitched together in a very good way, and the size of the chip will be larger, hence their cost will be more. I do believe the new line will be more expensive than the previous line, but what the company's going to do is they're going to keep both of these chips out there at the same time, right? If you need, essentially, it's a good, better, best strategy with the best being Blackwell and the better being Hopper. So both of them will be in the market. I can't imagine Blackwell not being more costly because it could be up to 2x the cost.
And Patrick, based on what you've been hearing so far, you've mentioned some of those rivals. Do you think this fundamentally changes NVIDIA's position?
So NVIDIA has close to 100% of the training, and I would say 95% of the inference for these latest models. I can't imagine them maintaining that market share, but the market is growing so much. This market could be 2-3 times the size of the current market in 2 years. So NVIDIA can continue to have a, let's call it a 90% market share position, right, down from 98%. That still gives AMD and Intel and NVIDIA all room to grow.
It was interesting, Patrick, when you kind of listened to Jensen Huang yesterday on his keynote. I think he was, clearly trying to emphasize this point that, we're not just a chip company. We're, we're software. We're networking. We're an ecosystem. That was kind of the theme, the storyline. How important is that for investors?
I think it's incredibly important, right? I like to say there's companies that show up with a bag of parts, and there's those that show up with a platform or a solution. And essentially what NVIDIA is doing is, you're right, they have the core accelerator, they have the networking that not only pulls the chips together on a single card, but also connects those cards together. And then they have the networking that connects the racks together. And you layer on top of that the drivers, the containers, the platform services that put them in a position where, let's say somebody does come out and has a better chip, NVIDIA is still competitive on a platform very similar to Apple, who hasn't had the best devices for a while, but they do so well because their platform play is so strong and their experience is so strong.
Patrick, what about potential supply issues? Do you think NVIDIA can produce enough chips to meet this demand?
So a little bit of a tricky question. I think there is fear amongst their customers. I mean, they love what NVIDIA is doing in terms of market making, but they do fear being connected to one company for supply chain risk. And to have a competitive supply chain, you have to have 3 players. So I think that with AMD and NVIDIA leveraging the same wafer manufacturer, and that's TSMC, and even for packaging, there's similar risk between the 2 companies. Intel is interesting in that they could make NVIDIA wafers and do the packaging. I do believe there's a deal at hand. So it's a maybe. Part of it is the growth, but also the outside world, the customer base is feeling about being locked into one supplier.
Patrick, I'm going to get you out of here on this. I'm interested to get your take on what the long-term risks are for NVIDIA, Patrick. And I don't mean just over the next 6 months or 12 months, but over the next few years, Patrick, what would you argue the big risks are? Is it competition? Is it demand holding up from those big tech customers? Is it just technology evolving in some way that proves a challenge? What would you list?
I would say the biggest risk is researchers now not figuring out the next big thing that requires bigger and faster chips from NVIDIA. The second risk would be competitive risk based on customers' desire to not be beholden to one company. There are some ancillary risks in that the top 3-4 hyperscalers out there, Google, Meta, AWS, and Microsoft, are all working on their own chips. And with the workload moving from training to inference, that could be a risk. So yeah, there are risks for sure.
Patrick, it is always great to have you on the show, my friend. Thanks so much for joining us today.
Thanks.
Another call of the day we are watching closely here, UBS reiterating its buy rating on Boeing. That's despite, of course, recent struggles. Analyst Gavin Parsons sees an upside of 53% over the next 12 months for that stock. He says the stock is at bargain prices here and is an opportunity for a long-term investor. So this one's interesting, Alex. So UBS still likes Boeing. Target is 275. Basically says, okay, we do have all kinds of uncertainty. We got regulators and production rates, but the stock's already gotten hit hard, he says, so valuation looks attractive. If you're a long-term investor, he's telling clients, this is a good buying opportunity. New aircraft demand is at record levels. Supply challenges create, he says, an undersupplied market for years to come. And rival Airbus, he's saying, has just limited capacity to really further expand market share at this point.
Yeah, I think considering where shares are trading today, they're down about 30% year to date, down 10% year over year, obviously massively underperforming the S&P 500's rise over that same time period. So the call here really being that now is the time to buy when the stock is cheap. UBS saying that markets are pricing in $8.5 billion in free cash flow. UBS has an estimate of $11 billion, and then Boeing itself has 2026 free cash flow guidance of $10 billion. So perhaps now is the time to get into the stock, but you have to be able to deal with all these near and long-term risks. Boeing is just constantly in the news. They were just recently in the news because the inner windshield of an Alaska Airlines plane cracked as it landed in Oregon, and this was a part of their next-gen 737 aircraft. So you have these very public issues that investors clearly don't want to hear in the news consistently when it comes to this company. But if you're willing to hold this stock for the long term, perhaps now is the time to get into it.
Yeah, there was also, by the way, an interesting report today that Boeing is exploring a sale of at least 2 of its defense businesses that reportedly financial advisors are kind of contacting potential buyers here and filling it out, gauging interest. It doesn't sound like there's any kind of definitive decision on this one yet. Maybe, who knows if it happens. If it does, of course, you can certainly bet Lena Khan, the FTC, would have some questions, but that's another, for sure, headline to watch.
Yeah, Boeing just consistently a very interesting stock to continue to watch. Well, coming up, shares of consumer goods giant Unilever rising after unveiling a strategic restructuring plan for its ice cream business. We'll get the latest scoop when Market Domination returns.
Time now for a look at some of the day's trending tickers as we near the closing bell here on Wall Street. Starting with MicroStrategy. Shares are falling after announcing the completion of another convertible notes offering to fuel its Bitcoin purchases. Here was an amazing stat here. So MicroStrategy, Ali, now does own about 1% of all Bitcoin with this latest purchase. This is per Bloomberg. Notes that the firm made its second multi-million-dollar purchase on Bitcoin in a little more than a week. Obviously, you know Michael Saylor. I mean, that's a Bitcoin believer if you've ever seen one. Started buying Bitcoin back in 2020, so he's been through the fires with this one, though it remains committed. The company now holds about 214,000 tokens valued at around $14 billion.
Yeah, MicroStrategy, the largest corporate holder of Bitcoin. Now, this is the second convertible debt offering in a week to raise money to buy Bitcoin. Interesting to see that the stock recover some of its earlier losses because it was down as much as 18% earlier in the session. We've also seen Bitcoin come down a bit from those record highs we saw a week ago. Now we're trading at just under $65,000 a coin. And I want to bring in Yahoo Finance's David Hollerith. He's been following this story for us. So, David, what do you make of MicroStrategy and really the future of this company?
Yeah, Ali, it's like very simple is that MicroStrategy buys Bitcoin consistently. Sometimes it issues debt to do that. And then crucially, it never sells its Bitcoin. And it's kind of crazy that the strategy is that simple. That's literally all they do. Founder Michael Saylor, they do own a cloud software business, but as far as how the stock trades, it's mainly a function of where the Bitcoin price is and whether or not it's going up and down. There's always a big premium between MicroStrategy stock and the Bitcoin price in terms of what the performance is doing. And the founder, Michael Saylor, who stepped down in 2022, remains chairman of the board at MicroStrategy, but he's mainly given his time to Bitcoin education. And to give you an idea of sort of how Saylor talks about Bitcoin, here's some of what he said in an interview with us last week.
The highest, best use of capital is to buy Bitcoin and hold the Bitcoin. The Bitcoin is going to appreciate in value faster than the S&P index. It's going to appreciate in value faster than commercial real estate. And so there's no point in selling the winner to buy the losers. And Bitcoin is the winner.
So the wrinkle here that skeptics and short sellers will point out is that since the beginning of the year, Michael Saylor does not sell Bitcoin, but he does sell shares of MicroStrategy that he personally owns. And he's on a consistent schedule to do that. And he's profited handsomely from that. So obviously insiders are allowed to do this. But that is sort of the other side of this is that Michael Saylor does obviously benefit from investors thinking that MicroStrategy is a company that will never sell its Bitcoin.
Yeah, well, we'll see if that Bitcoin can get back to those record highs. I'm sure Michael Saylor will be very happy if that's the case. But thank you, David, so much for that insight. Another stock we're watching today is consumer goods giant Unilever unveiling a strategic restructuring plan. The company announcing a spin-off of its iconic ice cream business while also trimming down its global workforce. So that ice cream business being Ben & Jerry's, Magnum bars, spinning off. I love me a good Ben & Jerry's half-baked all day. But this is a company that really wants
to...
That
is a delicious flavor.
Oh, it's the best one, 100%. But, they have a lot of brands under their umbrella there. They have Dove soap, Vaseline. They've been really wanting to simplify their portfolio. Now they are cutting 7,500 jobs as a result of this restructuring. They're going to be targeting underlying sales growth of mid-single digits after spinning off the ice cream business. And, the company's had limited growth prospects. In many ways, investors have been looking for them to streamline. There's also the social activism element of all of this with Ben & Jerry's sometimes being at odds with Unilever. So you wonder how much that played into things potentially.
Yeah, I mean, you touched on exactly the point. I mean, Ben & Jerry's is a very politicized company. And your pint of Cherry Garcia, Ali, it has very strong political opinions on all manner of policy, domestic and foreign. And that constantly created a lot of just drama and headaches and lawsuits. So you can understand, did that play into this? Who knows? I mean, I think more broadly, this is a CEO who wants to boost profits, wants to drive growth. He looks at this ice cream arm, and yes, I think they did about $9 billion in sales in 2023, but profit margins, they are not as attractive relative to other parts of the business. So you can understand why, just financially and strategically, why that makes sense.
Yeah, and I personally love Ben & Jerry's, and it's an ice cream that I frequent often, but I do wonder if it made sense within this company. So it'll be interesting to see.
The CEO also had questions.
Oh, yes. And I have asked the Ben & Jerry's CEO before, like, do you want to have any healthier options with the Ozempic craze, everything going on? And at the time, they said they want to stick to their guns.
Stick with what they know. Politics and ice cream.
Exactly.
Moving on, Disney's proxy battle with activist investors heating up. Star Wars creator George Lucas voicing his support for Disney's board and CEO Bob Iger. This comes as the media giant also secures support from proxy firm Glass Lewis in Disney's proxy battle, of course, with Nelson Peltz. So, Allie, this is your world. George Lucas, Hollywood legend, now saying he's going to support Mr. Iger in this proxy fight with activist investors. Lucas, big name, significant shareholder, so people pay attention to this one.
Yeah, he's reportedly the largest individual investor in the company. He did receive just over 37 million shares as part of the company's $4.05 billion purchase of Lucasfilm in 2012. And as you mentioned, this comes with the backing of a lot of high-profile names. We have JP Morgan CEO Jamie Dimon recently coming out and supporting the current Disney board and CEO Bob Iger. You mentioned that proxy advisory firm Glass Lewis, very respected in the space, urging shareholders to reelect the company's directors. We have about 2 weeks to go until that critical shareholder meeting. So Disney seemingly pulling out a lot of stops here to try and secure those votes for the board.
It does, though. I mean, get your take on this because you know the story so well. It looks to me like Iger has some momentum here. He's got big names coming to, sort of aligning themselves with him. He reported, and the street loved that last report. The stocks ripped higher this year. It's just interesting to see where the kind of momentum heads.
And Glass Lewis did reference that. They said at this point in time, it seems like Disney is on the path to getting to a better place within the company. Noted that there have been issues there, and there's no surprise that we've seen some of these proxy investors come out and challenge the current status quo at Disney. But right now, it does seem like Bob Iger is on the right path. And for more color on this road ahead for Disney amid its proxy fight, let's bring in Axios media deals reporter Tim Baysinger. Tim, great to have you here today. This is a company I cover closely here, and we were talking back and forth of whether or not we think Disney is concerned at all that they could potentially lose this board seat battle. Based on everything that's happened, we're 2 weeks out from that shareholder meeting. Do you think it's a possibility that Nelson Peltz could win this proxy fight?
I mean, I think right now, as you guys said, Disney clearly has kind of the momentum right now. I mean, their stock price has been up since their earnings call. The street obviously loved it, as you two pointed out. The next big shoe to drop will come, maybe today, maybe tomorrow, maybe Thursday, because you mentioned Glass Lewis, recommending Disney's board nominees, but the next big one will be, ISS putting their recommendation out, and they have a much larger client base. They're much more influential. So what they say really could swing the way this vote goes. If they, support Disney's nominees, then, you might see Nelson, and Tran maybe pull back a bit, or maybe because he already pulled back once last year, he's committed to seeing it through to the end. But if ISS somehow supports, both Nelson and former Disney CFO Jay Rasulo, who are trying to get on the board, then that makes that shareholder vote in 2 weeks very, very interesting.
It's interesting. What's interesting too, Tim, is just how, we talk about these big name personalities and choosing sides, and obviously we're talking about George Lucas today, but Triant has its own, website outlining their case in this fight, and it's just interesting on that site, Tim, when you look through it, they kind of highlight execs from companies that have, worked with Nelson Peltz, and on the site you'll see them saying very nice things about Mr. Peltz, kind of statements of support for him. Who do you think is kind of winning this very public campaign here, or do we not know yet? We're just gonna have to wait for early April.
Yeah, I think we're gonna have to wait probably until early April. I've covered this business too long to ever really make predictions with concreteness because things always surprise you. But I would say right now, Disney looks to be sort of in the lead in this battle.
And Tim, a big question mark has been succession and succession planning. That's been an issue that the activist has brought up. Disney has also said they're working internally to find a candidate. Some names that have been thrown around: Dana Walden, Jimmy Pitaro. How do you think Disney avoids another Bob Chapek disaster and really finds someone that has longevity at this company?
I think some of it is that, they have to settle on someone of one of these potential four candidates, and they have to stick with it. I mean, before Bob Chapek, you can name the long list of potential Disney CEO successors, from, Kevin Mayer to Tom Staggs, that were even put in that, especially in the case of Staggs, that were put in that COO role, which was seen as, okay, you're sort of the king in waiting for Disney. And then Iger, renews his contract. So I think the biggest thing that they could do to ensure a healthy and successful succession is that, they settle on one of these four people, or they decide to bring in someone from outside, and they stick with it. Iger doesn't renew his contract, and they finally pick someone, and Iger kind of steps out of the limelight a bit, which he, had trouble doing when, Chapek took over.
So succession, obviously a big question mark for investors. There's also other questions at this company when it comes to how they're going to achieve streaming profitability. We've seen the parks business slow. Obviously, linear TV has been on a serious decline. I'm curious to get your opinion on what you think is the main issue at this company and whether or not Bob Iger has done enough to address that issue for investors.
Yeah, I think two of their big issues going forward is their movie business. Obviously, Marvel, Pixar, and Star Wars, their big brands, have not done too well at the box office recently. Obviously, Disney and Marvel have really, really high hopes for Deadpool and Wolverine coming out this summer, but it's the only Marvel film this year, which is their lowest in probably a decade. And their other big thing is, as you mentioned, streaming. And not only that, but ESPN, what does its streaming future look like? What does this joint venture with Fox and Warner Brothers Discovery look like? They just named a CEO last week. So I think those are two of the big things, and just how do they manage the long-term and probably irreversible decline of their linear TV business?
All right, big shareholder meeting coming up. We're all going to be watching and keeping a close eye on it. Tim, thanks so much for joining us today. Appreciate it.
Thanks for having me.
Coming up, we're looking at how the Fed could impact your portfolio in today's investor playbook. Stick around. More market domination on the other side.
Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th.
With just over 10 minutes left until the closing bell on Wall Street, we're looking at how to navigate the big picture with the Yahoo Finance playbook. Today, we're taking a closer look at how the Fed could impact your portfolio and what's driving the broader market rally.
Yes, we're highlighting expectations for the Fed's March meeting and what that means for your investment decisions now and looking ahead. Joining us now is FM Investments President and Chief Investment Officer Alex Morris and Macro Institute Chief Investment Strategist Brian Nick. Thank you both for joining us. And Brian, I want to start with you. Obviously, all eyes on the Federal Reserve and their interest rate decision tomorrow, but I do think the biggest focus is going to be on that dot plot. So what are your expectations for that?
So this might be a weird Fed meeting in that the markets and the Fed are relatively aligned coming into it, which has not usually been the case. The market's been looking for the Fed to make pivots here and there in the last couple of meetings. I think this one, the market and the Fed are both expecting kind of the same thing as the last time we've heard from them. And the Fed speak since the January meeting doesn't indicate we're going to be getting a much different message on inflation or on the unemployment outlook. So my base case is that we're going to continue to see expectations baked in the Fed dot plot for 3 rate cuts this year. That's about what the market's expecting too, which means potentially not that many fireworks after the announcement tomorrow.
All right, Alex, I want to bring you in here as well. What's your take, Alex? Tomorrow, what are you expecting the Fed to do and say tomorrow, Alex? Are you expecting the same thing, not a lot of fireworks?
Yeah, I'm hoping for no fireworks. I guess we're always kind of hoping for that. But I agree. I think we're going to see rates held steady. We're going to see the dot plot look pretty much the same. I wouldn't be surprised, though, if there were some outliers who pushed us to 2 cuts or someone who might even be looking at 1. Which I think might spook the market a little bit, but I think the odds of that are low, and any response would be relatively muted.
Alex, just a quick follow-up on there. Does it matter to you, Alex, when exactly they start cutting?
I think it matters less to me than it does to them, and that there be a regular program, and that's because what's about to happen in November. The Fed, although it is by design outside of the political system, it is still highly politically aware, and it wants to have a program, I'd argue, where it doesn't look like rates are being cuts are halted as a result of the election or who might be leading the election at that point. So I think from them, they want to have a clear message, as Brian said, aligned with the markets and a consistent narrative. So when cuts come, it doesn't look like it's designed to favor any one politician, party, or policy.
So, Brian, we just heard Alex bring up the election conversation. Obviously, it seems like there's still somewhat uncertainty when it comes to when we could get these cuts, how many we could expect. How are you advising your clients when it comes to positioning their portfolio amid this Fed uncertainty?
So this looks like it's going to be the second longest plateau for the Fed funds rate that we've ever seen. The longest one was 15 months between the last Fed rate hike and the first Fed rate cut. That actually came in 2006, 2007. I think dare say the Fed probably wishes it would have cut a little bit sooner at that point. So because this is so unusually long, what we're looking for really is any signs of a break in the economy. Is the economy sort of going to wilt under the pressure of higher interest rates? Now, we don't know exactly where the neutral rate is. That's one potentially source of surprise that we could see tomorrow in the dot plot. If a few FOMC members raise their estimate of where neutral is, that's effectively changing policy without actually changing rates. But I think the concern that we have is that we're going to start to see further weakness in the labor market data before we get down to 2% on inflation, which seems like it's sort of the bogey for a lot of these FOMC members. And that means the Fed's going to have to really choose between, do we have to wait for inflation to get all the way down to 2%, or do we try to forestall what looks like a coming weakness in the labor markets and in the broader economy?
And so does that mean, Brian, I'm just interested in your outlook for the economy then. Are you in a soft landing camp still or no?
No, we've never been in a soft landing camp. We're in a hard landing camp.
Hard landing.
And this, we're becoming an endangered species. But the weakness that we're seeing in some of the survey data as relates to small businesses, poor sales, weak hiring, these are the things that tend to lead by about 3 to 6 months actual changes in the hard data. So we're waiting for that to hit around the time when the Fed is expected to start cutting rates. It may have to start cutting sooner or faster than it wants to.
All right, Alex, how about you? I have to get your opinion. Are you in the hard landing camp, the no landing, soft landing?
You know what? I've been in the soft landing camp and still there, but I'd point out we've done a pretty good job of poorly defining what is hard, soft, or no. I think where I agree is that there could be a risk of cuts coming at a different rate than the Fed expects because, let's face it, for a long time, it's done something it's not used to doing. It's had a campaign against employment in an effort to bring it down. And we're starting to see that. We saw it happen late last year. We're seeing little bits and bots of it now. But I think the Fed is also thinking about something else. Commodity prices are starting to tick up, and that usually leads towards inflation in and of itself. So I would suspect right now most folks sitting at the governor's table are wondering, okay, we kind of know what to do from here if all goes to plan, but what are the things that might happen outside of the plan? And what if that is inflation from commodities prices that start to trickle up, and that also makes employment worse? How do we deal with the need to cut and rise all at the same time? And I suspect that's where we're going to start to hear more Fed speak in the back end of this quarter, and certainly a lot of that in Q2.
And Brian, back to you. So given kind of the backdrop, Brian, kind of your outlook for the Fed, for the economy, in the equity market, where do you want to be positioned, Brian? What sectors look attractive to you?
So this is the stage of the cycle where you typically see a risk-off rally. So it's possible the stock market can keep going up, but it's going to be led by more defensive areas of the market. Again, we can go back to the last two major cycles. It's exactly what happened in 2000, 2007. The tech rally and the financials rally relinquished to utilities, consumer staples as we got the last gasp of the overall S&P 500 rally. And once that tapped out, it was around the time when the Fed was cutting interest rates because employment was getting worse. So we're looking for, again, ultra defensive sectors of the market that are correlated with interest rates. So when interest rates are falling, they're going to tend to outperform. We're looking for utilities, consumer staples, certain parts of the healthcare sector, your classic defensive counter-cyclical parts.
Mm-hmm. And Alex, if we are in this higher for longer period, what do you think of interest rate sensitive areas of the market like small caps? Do you believe they're undervalued and now is a time to buy in?
So I think small caps have been undervalued for a long time, and it's a good time to buy them. I don't know if the interest rate change is going to be the immediate trigger for them. I think that's going to be a flows-driven rally. It needs to get enough buyers back into the market to push them up. Because arguably, we can look at the Fab 4, right? It used to be Mag 7, but now really just 4 that are still making new highs. That's not because efficiency is improving or free cash flow is growing at great rates. It's rather just supply and demand. And we need to see a bigger impetus for that to move out of those biggest mega cap, large cap names and work its way down. Interest rates may be part of that, but I think it's going to be largely sentiment driven. Once you see volume going to those funds, those ETFs, those SMAs, you're going to see the rest of the volume follow pretty quickly.
And Brian, got your outlook for kind of the equity market for fixed income investors who are listening right now. Any advice, guidance you'd give them?
Spread compression has been extremely aggressive. We tend to think of this as a leading indicator, but it feels like that the credit market's already leading us past the downturn to the next recovery. We're pretty cautious. We like long duration, high quality. We've been talking about buying long treasuries since last year when rates were kind of at their top. Those were going to tend to be one of the only things that work in a portfolio of diversified asset classes when things get really tough.
And then Alex, we've been talking about this broadening of the market right now, especially when we talk about tech sort of pulling back. Where do you see that market broadening to? And do you think there are other opportunities out there besides just the Magnificent Seven?
Yeah, I think there are a lot of great opportunities. I agree with Brian. First of all, if you want to be out of the equity market, something like U10, UTWY, U30, get really targeted treasury exposure on the long end of the curve. Within the equity markets, I like energy as a sector. It's trading at about twice the buyback rate and twice the dividend rate of the broad S&P 500. You can do that through a name like Diamondback Energy, FANG, which is more of the high beta side. Upstream producer has a lot of capability and efficiency. Or if you want a more low beta version of that, something like MPC and Marathon, where you're going to get a little more diversified, a little more muted exposure, a little more of a value play. And I think that sector also ties into if energy prices continue to go up, which looks to be set, or other commodity prices go up, they have two ways to benefit from that, as well as being a hedge against some of the tech names starting to fall.
All right. Brian, Alex, thank you guys both for joining us today. Appreciate it.
Thank you.
And while we're wrapping up today's market domination, don't go anywhere. The S&P 500 is on track to close at a new record here. Stay tuned for market domination overtime. That is the closing bell on Wall Street now. It's market domination over time. Let's get you up to speed on the action from today's trade. Let's see where the major averages ended here. Stocks are in the green right across my screen, all three major averages. It looks like the SPX, the S&P 500, will be able to close at a record. Remember, it was 51.75, and I think we're going to do it. It looks like 51.78, a gain of about 0.6% here. Meanwhile, the Dow Jones Dow is going to tack on about 0.8%, about 320 points. Tech-heavy Nasdaq takes the bronze up about 0.4%, Allie.
Yeah, and I'm watching the chip sector. We're seeing AMD shares lead the broader chip sector lower today, closing down about 5%. It was down as much as 7% earlier in the session on the heels of that Nvidia conference. Chip equipment maker ACM Research closing down 4%. That did fall as much as 16% earlier. But when we talk about Nvidia, this was a stock that was down earlier today, but did end up closing in the green, up 1%. It began to reverse some of those losses in midday trading around 12:30 p.m. Eastern. So investors seem to be really digesting this new chip news, Blackwell, the importance of it as we think about the implications for the broader market as well.
Yeah, it was interesting to watch kind of Nvidia's price action today because we were in the red. Looks like we're going to finish higher there by about 1%. It was interesting because we were talking earlier with tech analyst Patrick Moorhead, Allie, and just kind of the story that Jensen Huang was telling in that 2-hour keynote and really kind of hammering home that, listen, we are a chip giant, but his point was we're more than that. We're a true ecosystem, right? He talked about the software and the networking and how, when we talked to Patrick Moorhead, how critical that is for investors.
Yeah. Well, the two main themes, we've been talking it, Nvidia and the Fed. Yahoo Finance head of news, Miles Udlin, is here with his takeaways from the day. And Miles, you're focused.
That's it.
You're focused on it.
Nvidia and the Fed. Great to see everybody. Have a great night. We'll see you guys tomorrow.
We're out.
So the Nvidia part of this, let's leave aside yesterday's announcement, all the tech innovations, how Jensen's kind of positioning the company. Josh, as you mentioned, beyond just a hardware maker, ecosystem, et cetera, et cetera. I think when you look at Nvidia and the semiconductor industry at large, at this point in time, it is probably worth recalling where this industry has been at various points over just the last few years. It wasn't until, I don't know, maybe the middle of last year, later half of last year, that we kind of maybe forgot that the semiconductor industry is traditionally one of the most cyclical of all industries. And we have seen with Nvidia itself, the stock itself, over the last couple of years, two different points, second half of 2018 and then pretty much all of 2022 when the stock fell 50% or more. In the case of 2022, it was down almost 2/3, with everything else. But you look at the chart today and it's like, well, who's this idiot? What do we care about the stock going down at some point over the last few years? But there is a sense of, Josh, I'm sure you had this thought watching it last night. The arena's full of people cheering someone on stage, talking about semiconductor chips. And it just has this kind of this celebration around it. And it's amazing technology. It's stuff that I really don't understand because I'm just a guy who talks on the internet for a living. But it just had this, feel of, are we sure this is what chips are all about? Is it really a Warriors game? Or
I thought it was there.
I thought it was just the stuff that goes in phones.
It's a Warriors game for tech investors.
Yeah,
maybe that's how you should.
It feels like a little much.
He had the leather jacket going. He was selling all the drama.
As
it was
always.
Fantastic. It was. I guess it comes down to Nvidia is just the face of this boom of interest in AI. It is the leader in AI training chips. I thought it was interesting. We were talking to Patrick Moorhead about this, and when you have this kind of run, as he was saying, there's all kinds of companies that are gonna put a lot of time and effort and money to play catch up. And you see with AMD and Intel and even, of course, NVIDIA's own customers, the hyperscalers, big cloud giants. But how many analysts, Miles, we've had on this show? And listen, they're all bulled up. It's hard to find someone who's not bullish on NVIDIA. But I do think that's a common theme is while they acknowledge the competition, at least one thing we've heard here is they're just still so far ahead of the competition.
Right. Yeah, I think my thing is particularly looking at the 2018 downturn in NVIDIA stock, which was about the lack of demand all of a sudden for their chips to build out crypto
mining. Could
mining.
you argue, Miles, that was also, like if I was putting my Nvidia bull hat on, they would say, because I remember.
I think the Nvidia bull hat means none of this matters, but yeah, please continue.
The bust, the kind of boom and bust cycle, when an Nvidia bull say, back then we were talking about it was gaming and crypto.
Yeah.
And the business has changed, the business model has changed, where they're placing their bets has changed.
Well, so I guess my thought around it is that a semiconductor company, and this is really why the ecosystem is such an important part of the current pitch, is that semiconductors are hardware. Therefore, they are at the risk, they are down cycle from where business spending is at. So essentially, their chips get more orders when there's this thought that there's going to be some upcycle in crypto mining in that instance. Kind of just the whole tech world was booming in 2021 in the second. And so now, the story is being redefined as like, they're not at the risk of anything. Nvidia is the thing. Therefore, it is different this time. But I just think when you are at heart, fundamentally, a hardware company, and Apple pulled this off, right? They went from being a hardware company where they make most of their money still, but the services story came into it, the upgrade cycle. It reframed that story. Totally. Maybe this is the moment for Nvidia, but it's just worth reminding ourselves on the day after we fill a stadium of people talking about chips that this is a very unique moment for a company that has seen a lot of cycles. Like Jensen Huang would tell you, they've lived a lot of lives. He knows that's what makes them what they are today, but there's this sense on Wall Street, we'll never live another life. This is the only life NVIDIA will ever live, and it will be, the greatest company forever.
And if it's the only player out there, how
so
do you
far ahead of
address
the competition, all this stuff.
demand issues too?
Yeah.
But Miles, another thing you have your eye on is the Fed, and you say this dot plot could be the most important dot plot of our generation. Look, I usually pride myself on the transitions here, but I feel like it is the two biggest stories.
Part of me was thinking maybe we'll just end it with NVIDIA. We've talked enough about the Fed. No.
Oh, I love the dot plot, so we gotta talk about it.
Don't worry, we're rewarming this take for viewers of the program.
Maybe Jay Powell takes the stage tomorrow
Tuesday.
Rocking a leather jacket, and you bring it full circle.
You know what I think?
Now you got something.
I think there's probably there's a way to ask Powell a financial stability question around NVIDIA and what you've seen in the stock market.
They've done it with Taylor Swift.
We're gonna get you. Miles, we just gotta get you in the meeting. You'll think of it. You'll get creative.
Look, that was from a past life. Look, the dot plot, it's all anyone's going to be talking about. I just think it is worth reiterating that the reason that everyone cares about the dot plot this time around is that it has actually been, despite Powell not wanting to talk about it being a guide for policy, it has been by far the best guide to policy. It was the place where the Fed's hawkish tilt last year was best laid out. And while no one wants to be beholden to a bunch of dots on a piece of paper, it's where markets are going to focus because it has been, it's been the map that the Fed has followed over the last 15 months or so.
And it's interesting too because some of our markets guests, they've said they don't really expect a lot of fireworks. And even if the Fed does say they only see 2 rate cuts instead of 3, that might spook the markets a little, not that much. 1 cut though would be a surprise. What do you think? If let's say we do see 2 cuts instead of 3, do you think markets will go haywire?
I think there's an argument. So, the whole thing is as we've talked about a million times, market saw 6, Fed saw 3, they've converged to 3.
Yeah.
I think you could argue that the market coming to 3 is anticipating the Fed actually going to 2 or 1 over the balance of this year, right? So that's what's being quote unquote priced in. But we don't know that for sure until the dots actually come out and the market actually reacts. Ex post, we'll be able to say, was it or was it not priced in? Take it to its logical conclusion. Everything is always priced in because the market, incorporates all available information in an instant manner, et cetera, et cetera. But I think to me, it's that limit of was it 2, was it 1? Does the Fed go to 0? Does it stay at 3? I actually think that's probably the quote unquote risk. Stays at 3, then what? S&P is going to be up 2% tomorrow? Everyone's assuming there's going to be some kind of hawkish slant, but what if there's not?
Yeah.
I'm
We
excited.
await Big J. Let's see what happens.
I mean, he's not going to, but what if he cuts rates tomorrow? No, I'm kidding. That'd be fun, but Fed doesn't want to be fun. Fed doesn't want to be fun.
I always like a
They're
little
not
surprise.
an entertainment product. We're here to have fun. The Fed, not here to have fun.
Exactly.
Miles, thank you for joining us, my friend. Always great having you. Now that the NVIDIA event is behind us, the market's focus is on the Fed decision tomorrow. And despite concerns about rates staying higher for longer, stocks posted gains on the day with the S&P 500 closing at a new all-time high. But our next guest says investors shouldn't be focused on AI or the Fed. The next true catalyst is earnings season, which is just a few weeks away here. Joining us now is Michael Antonelli, Baird Managing Director and Market Strategist. Michael, I do have to start on the markets, though. Listen, Mike, we end today. The Dow tacks on another 300 points here. The SPX notches a record close. Things seem pretty good. Where do you see the market headed here in the near to intermediate term?
I love that I got to follow my friend Miles. He's one of my guys. So I looked at my board up here, the number of times I've been on Yahoo Finance, and I've been at new all-time highs 3 times. So I'm counting myself as part of like the good membership of Yahoo Finance. I think the market is what it is, and we're overthinking this whole thing. We're totally overthinking this whole thing. Let's put the dot plot aside for a second. Let's put Nvidia and rockstar status aside for a second. Earnings are at their highest level in history. Earnings expectations 12-month forward are at 249. We are at all-time highs. Why? Because earnings keep going up. Earnings estimates keep going up. Can that change? Obviously, it can change. For sure, it can change. But we have a consumer with a solid balance sheet. We have earnings estimates going up. We have this AI theme. Things are good. We're overthinking this. Let's just focus on the fact that earnings season is the next catalyst, not the dot plot. I think it's not the dot plot. Even though I agree with Miles, it's probably like 2 or 3.
Okay, Michael, I'm going to push back a little, though, because we do have inflation that is pretty high, and there have been stickier areas of inflation, like shelter, for example. And really, the housing issue seems to be an impossible scenario to navigate in some ways. How do you think the Fed should approach those areas that just don't seem to be coming down?
And that's it, right? We could look at CPI over the past 6 months. It's annualizing about 3%, but if you were to take out shelter, it's 1.8. I know that's kind of lazy to say take out something that actually everybody consumes, so I'm not going to play that role. Okay, yes, shelter is high. It's high for basically structural reasons. We don't have enough homes, and the places that need more apartments are slow to get new apartments. So we're in this kind of structural problem that the Fed can't solve. The government can't really solve it. We're in this demographic patch where millennials, all of you guys are buying so many homes, we don't have enough of them. So we're in these kind of structural situations that the Fed's going to have to like just acknowledge and say shelter's not coming down as fast as we thought, and there's really not that much we can do about it other than slamming the brakes on the economy. But again, how many people have a 3% mortgage out there? So many. So many. So you can't make those people move. It's kind of an intractable problem here.
No, listen, I get you, Michael. If I was locked in at 3%, I'd never be moving. Let me ask you, what bottom line do you expect to hear from the Fed tomorrow? And when do you think, Michael, they start easing?
They're going to have to push it out, but they can't push it out too far, right? They can't push out they can't push out the cuts towards the election. Then you're going to just start to drum up all sorts of like unnecessary concerns about cutting around an election. So if they're going to guide, they're going to have to guide sometime a couple months before that election season really starts to ramp up. You know, we keep asking the Fed to cut, and they keep saying we're watching, and then the CPI comes out hot, and then they say we're watching. We're just keep doing this cycle. Will they cut? Won't they cut? Does the market care? I mean, if CPI is coming in hot and they keep pushing out cuts, why are we at all-time highs? Does the market just not see this? Clearly it does. I think, again, we're overlooking the simple answer here, which is that the economy's fine, the consumer's fine, and earnings are rising. The Fed is important, yes, but we're putting way too much importance on dot plots, and we need to start thinking about the stuff that actually matters to the market right now, and that's the thing I've mentioned about 6 times so far.
Mm-hmm. So then to that point, do you think there's any difference between 2 cuts versus 3 cuts, or even if we don't see any cuts this year?
I think the market will be fine with no cuts. I really do. I mean, I don't think the market needs cuts to go higher. Will that help? Yes, maybe if they say we're cutting soon, certainly I think the market will be up pretty big over the next few days. I don't know if this is a hot take, but I don't think the market needs cuts to keep going higher. As long as earnings and the consumers stay fine. Your previous guests were a little bearish for my taste, talking about a hard landing. I don't know what that's all about. But I think we're in the no landing category. There's no landing. We're off. We're just going. But I don't think the Fed. I don't think we need a rate cut for the market to go higher. I'm gonna stake that claim right now.
Michael, to your point, yeah, I don't remember last time I had a hard landing guest on the show. So at least it was kind of refreshing.
Yeah.
It was something new. So Michael, as you look across the equity market right now, and just given the backdrop you've kind of laid out, what sectors look attractive to you, Michael? What would you find? Where do you see opportunity? And by the way, what also would you avoid?
I certainly like tech is what it is. We talk about tech nonstop. I think the industrials and the consumer discretionary space to me are the most interesting. I think there's a lot of interesting, well-run companies in there in the consumer space. I do think housing is still a great look at ITB, the housing ETF today. It's near its all-time highs. Some of the home builders back close to all-time highs. If the market was worried about rates or if the market was worried about inflation, why are these home builders still continuing to do well? There's a lot of industrial companies, a lot of financials, I think, that are doing well. We don't always have to talk about tech or Nvidia. That certainly that gets a lot of oxygen in the room, but I would probably stay away from some of the consumer staples, some of the defensive names. I just don't think it's the right time to take up the defense. I think it's okay to continue to play what's working. And right now, industrials, financials, even tech, they're all doing really very, very well. And honestly, let me just throw out a stat. By the way, the market's up 8% through for the first 50 days. If it's been at least up 5% through the first 50 days, it's been positive 24 of 25 times. The only outlier is 1987. And that always shows up on all this stuff. 87 always shows up. But being up this much into the year is actually historically a really good sign.
What about the energy sector, Michael? That was a top performing sector today. We've seen commodities really ripping across the board. Are you bullish on energy in the long term?
I mean, I'm the kind of guy that thinks a bet on commodities is a bet against human innovation. So you might have the wrong guest on betting on commodities. I'd rather bet on new products and innovation. And certainly the energy sector has done well. We do have a kind of a perky crude oil up back above 80. I mean, energy does have a place, I think, in a portfolio, especially if you're looking to diversify. So I'm not going to say that I completely would avoid it. That's not the case. But I do think a big bet on energy is a bet against human innovation. And that's just not my brand. That's not my style, really. So I still like the financials and discretionary and industrials better.
All right, Michael Antonelli, thanks so much. We'll get Miles back, and then you guys can have a little bit of a reunion. But
thanks.
Appreciate it. We'll get you back soon. Thanks so much. Coming up, we're heading out to San Jose to check in at the Nvidia GTC conference, where Dan Howley will catch up with their vice president of automotive. More market domination overtime coming up.
We're here with NVIDIA VP of Automotive, Danny Shapiro. Danny, thank you so much for joining us here at GTC 2024. Kind of a huge event. This particular one, first time in 5 years that you guys are live, but also because of all of the AI hype going around. I guess, you know, just to get things started, Has the AI hype that we've seen around NVIDIA trickled into the different businesses? How has it impacted the automotive side of things?
Absolutely. We're seeing this amazing development going on throughout all aspects of the auto industry. One of the things we're focused on is AI supercomputing in the car. So creating an AI brain for automated and autonomous driving. So we just announced a new platform called Blackwell at the keynote yesterday. This is going to really help in the form of generative AI. The kinds of things that ChatGPT is doing, being able to take data streams in and other data streams being generated, whether it's text to text or text to image, text to video, or video to text. I mean, so it doesn't really matter what it is. And so we're seeing that kind of technology helping transform what will go inside vehicles, whether it's cars or trucks or robo-taxis, being able to have a natural conversation with your vehicle. But also it's really helping the development of autonomous vehicles as well. So in generative AI can be used to assist simulation for testing and validating autonomous vehicles.
So it's not just ChatGPT or Sora, which is the video generative AI capability that OpenAI has. It's something that's going to actually, I guess, manifest some physical way down the line.
So imagine an automated car, and there's cameras on it that are understanding the environment. Well, what we can do is generative AI can take that video feed and understand it, communicate it to you in real time, and alert you to the fact that maybe somebody is jaywalking, or there's a baby stroller being pushed across the street here, or a motorcycle that's coming in your blind spot. So the cameras won't just create a beep, but actually could tell you what's going on.
So I guess, how far away is that? We're still, ChatGPT was what, 2022? So it seems still pretty early, right? How far away is that, and how long has NVIDIA been thinking about that kind of technology in the car?
So we've been focused on in-vehicle experiences for more than a decade, and we really pioneered bringing kind of consumer electronics experience into the cockpit, touch screens, digital instrument clusters, rear seat entertainment. And the last several years now, we've been bringing artificial intelligence to that as well. So having a concierge that you could interact with, convenience and safety features, all built around AI. So being able to understand what's going on outside as well as inside, who's in the vehicle, what's their agenda, where are they going, what do they want to do, and merging all of that together. So what's nice now is that these large language models are really enabling new experiences. And instead of having to learn specific commands for your car, you could speak to your car in natural language.
So I guess this is something that is now kind of coming to fruition. And during the keynote, Jensen had mentioned a number of new deals with automakers. I guess, can you just give us a sense of what those mean? Some of them, BYD as well as a few others. And where do you see those kinds of deals going?
So BYD is really exciting. They're the world's largest EV maker. And so they're going to be using Drive Thor. So that's our new AI supercomputer for the car. It's automotive grade, meaning it's designed to work at all temperatures. Unlike your phone, which won't work in the cold or the heat, our Drive computer will work under all conditions. And so that becomes the AI brain for their future fleets of cars. But BYD is also using NVIDIA AI for training the self-driving. How do you teach the self-driving car? So their data centers have NVIDIA inside. They're using NVIDIA for simulation for their factories, to be able to plan the factories using NVIDIA Omniverse. So that's our digital twin technology. NVIDIA IXIC Sim, so this is the robotics stack as well. So how are these robots going to build the cars while they're using NVIDIA artificial intelligence as well in the factory? And even retail. So we can use Omniverse, which again is the digital twin technology. We take a model of the car that the designers used, and with generative AI, we can put that model anywhere. We can envision it on the highway, on a country road, by the beach, in your driveway. So the retail experience and dynamic car configurators will be something that will transform going to the dealership or just buying a car online or on your mobile device.
And just one last question. Where do you see this kind of technology going for NVIDIA in the year ahead, 2 years from now?
Yeah, The explosive growth of AI is quite astounding, but we're just getting started. That's the exciting thing. These vehicles that we're making, it's not like it's a fixed vehicle and just ships, but it's a living entity now. There's a supercomputer on board, and we can update the software on the car so it can get better and better over time. So when you buy the car, it'll be at its most basic level the day that you drive it home, and it will just get better with new software updates over time. So we'll be able to add new features, new capabilities, new autonomous driving modes, and it'll just be a really joy every time you get an update and there's something new, a new app essentially for the vehicle.
All right, Danny Shapiro, VP of Automotive at NVIDIA, thank you so much. We're going back to Ali in New York.
Thank you, Dan and Danny Shapiro. Appreciate it. Time now for To Watch Wednesday, March 20th. Starting off with the Fed, investors are keeping a close eye. The second FOMC decision of the year on tap. Expectations for a rate cut are basically at zero here, but the focus will be on the dot plot, which will show FOMC members' estimates for rate cuts. Fed Chair Jerome Powell will hold a news conference following the decision, and Yahoo Finance will begin live coverage at 2 p.m. Eastern.
Moving over to the earnings front, Micron, General Mills, Five Below, Chewy, KB Home, and Signet Jewelers all reporting tomorrow. Micron announcing second quarter 2024 earnings after the bell. The chip-making giant has had a solid start to the year, up about 10% year to date and closing higher today, continuing to establish itself as a legitimate AI play in the eyes of Wall Street right ahead of earnings.
Also, after closing bell, we're expecting Reddit to price its initial public offering. The social media company is eyeing a valuation of up to $6.5 billion and is set to start trading on Thursday. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow for all of your coverage leading up to and after the closing bell. Stay tuned for more Yahoo Finance on the other side.
Here at Sarah Week by S&P Global, I'm Julie Hyman of Yahoo Finance, and we are talking, amongst other things, about the energy transition. But of course, natural gas has become a big part of our energy system here in the United States, and I'm here with someone who is a big part of that in turn. Pierce Norton, who is CEO of ONEOK, one of the companies that is responsible not only for E&P but also for pipelines, getting natural gas around the country. Thanks so much for being here.
You're welcome. You're welcome. Thanks for having me.
So first of all, I want to talk a little bit about natural gas markets and what we've seen go on there, because we've seen the price come down quite a bit, down more than 20% or so over the last year. What effect does that have on your business?
It actually has little effect on our business because we're primarily a fee-based business. So the way we make money for our shareholders is actually just moving the molecules from point A to B. And what we basically do is we're taking those molecules and transporting them to where they have the most value. So most people don't know that natural gas, when it comes out of the ground, you actually have to process it and treat it to get it in a marketable form. That's what we do.
And so you all have made a big acquisition in Magellan that closed last September. When it comes to scale in the pipeline business, is bigger better? How do you think about the strategy behind that acquisition?
Well, actually, Julie, bigger is better. And the reason is because it provides a lot of organic opportunities for you. So you get some interlays between the systems. One of the things that we wanted to do with Magellan is diversify our asset base. So we were already in gathering and processing, transmission of natural gas, and the movement of natural gas liquids, but we didn't have refined products in the crude oil piece. And because if you overlay our assets, you can actually use some of the same pieces of pipe to move different products. So we've just expanded our footprint, and it's a tremendous opportunity for our company, our employees, and our shareholders.
So in other words, if you have one pipeline, you might have sub-pipes within it running different types of product?
Actually, what you can do is you can put different products down the same line. It's called batching.
Oh, is it because they're different weights? Is that how it works?
It's because you can actually put two different kinds of products in the same line, and when you do, there's just a small interface in between it, and so you can catch that at the other end and separate them into the tanks that they need to go into.
Interesting. As I mentioned, there's a lot of talk here at Sarah Week and in the general conversation in the energy industry about the so-called transition.
Right.
But of course, recently there's been a little bit of pushback against the notion that oil and gas is going anywhere anytime soon. How are you thinking about that and the role of the products that you transport?
We actually do a lot of studies on this, Julie, and what you really realize is that we've actually been in a transition for 200 years. The country started out actually using wood, for its energy source. And then we added coal, we added natural gas, we added nuclear, and then now you've got geothermal, you've got the renewables, which is the solar and the wind. But we've actually built on it, and the reason is because the population increased and the demand, because of your standard of living, increased in the United States. The same thing's going to happen in the rest of the world. So there's going to be continued growth in those areas, but we believe it's more about energy addition than necessarily energy transition. And one more thought on that is, when you say transition, you're implying that you're moving from one energy source to another, and you're never going to go back. But if you really study it, it's more about transformation than it is transition.
Meaning what?
Well, meaning that you can use the same thing in maybe a different way. So you can use natural gas to form hydrogen or ammonia or those kind of things. It's just a tremendous opportunity for, I think, our country as far as energy goes, and especially the midstream aspects, which is the pipelines.
As you think about, too, you mentioned developing world moving through different energy sources as well. Do you think that you will end up exporting more of your product and not just piping it around the U.S., but piping it to an export terminal? And do you think demand will be greater even in other countries than in the U.S. at some point?
Well, here's some statistics for you. Over the last 20 years, we've basically consumed around 100 quads of energy, which is just the way we measure the energy source in the United States. May fluctuate 2 or 3 quads a year based on weather. But what's going to be the interesting thing is to see how data centers use energy in the future, and whether or not our domestic energy consumption actually starts to grow because of data centers. but then the rest of the world is going to continue to, and we already export 12 to 15 BCF a day, not us personally, but the industry does, offshores of the United States goes all over the world.
When you talk about our energy necessities, though, as a result of data centers, that's a really interesting topic. It's one that we've been talking a lot about recently. The question is, even if natural gas and other energy sources can provide that energy, can the grid have that capacity to meet the demand from data centers, for example?
The short answer is probably not. So that really gets into the conversation about infrastructure, whether or not it's pipelines, processing plants, fractionators, petrochemical plants, or even transmission lines, and the ability to build more electric generation in the United States. So I personally think we got to think a little bit bigger.
And on the pipeline front, there has been some talk about reforming the permitting process for pipelines. How optimistic are you that that's going to get done? And would ONEOK, where are you on, would you consider putting in an application for a new pipeline, or do you think it's just we're too far away from that process being more streamlined?
Well, at ONEOK, we do this every day. I mean, that's what we do is we permit pipelines, those kind of things. And what I am appreciative of is the dialogue, because just a few years ago, we weren't talking about permit reform. We were talking about more regulation. So now you're talking about it, so which in our opinion, it really focuses on the issues and not necessarily picking sides.
All right, thanks so much for being with us. Appreciate it.
You're
Pierce
welcome.
Norton of ONEOK.
Thank you, Julie.
Thanks so much for your time.
Wireless companies have been piling hundreds of billions of dollars into 5G infrastructure in the U.S. over the last few years, but haven't really been reaping the benefits so far. But it seems that 2024 may be the year that things seem to change, at least for a few telecom giants. According to our next guest, joining us now is Keith Snyder, CFRA Research Senior Equity Analyst. Keith, it is good to see you. So it's interesting, Keith, your point is that, listen, these wireless companies, we know they've dedicated a lot of time and effort and a whole lot of money to 5G, Keith, but they haven't really kind of monetized that yet, at least in a kind of meaningful way. Maybe to start, Keith, I'm just interested, why is that? What are the hurdles here that you would outline, both on consumer and enterprise?
Sure. I mean, this is kind of the first generation that we've seen that just providing connectivity services isn't enough. So, looking back at 4G LTE, 4G, 3G, just, being able to connect people to each other, that was good enough for wireless companies. With 5G, you have so many other alternatives. You have, Wi-Fi 6, you have satellite internet coming out, with Starlink, and Amazon's planning a big network. You have competition from all sides. And so now it's become a services game. And really what we're seeing is, these companies are going to need to, one, communicate to customers what they can offer, but two, really redefine their business model, as on the consumer side especially. People didn't care about 5G. I mean, 5G is nice to have, but when they tried to push price increases, adding, $10, $15 per month for 5G services, people really pushed back, and they walked back on that really quickly. And so consumers just don't want 5G, and they don't want to pay more for 5G. So, it's going to be interesting to see how, these companies monetize the hundreds of billions that they're pouring into these networks every year.
When do you expect these companies to be able to eventually monetize? Is that soon, or are we still ways out from that?
I mean, we've seen it in somewhat of an indirect way with fixed wireless access. And so that's basically providing broadband service via 5G network. The issue is, you have companies like AT&T and Verizon who have existing wireline broadband businesses. So they have to be really careful about what markets they roll these services out to so they don't cannibalize their own businesses. T-Mobile's been pushing really hard on the FWA front. But at the end of the day, given that fixed wireless access customers share the same network as wireless customers, it becomes a congestion issue. And so what we're seeing is companies, kind of cap the number of customers they're willing to sign up, especially, on the AT&T and Verizon side. But, looking to when they can actually fully monetize it is probably going to be next year, if not another year beyond that. It's going to be the enterprise customers who are, really clamoring for the really cool technologies that we're seeing with 5G, network slicing, low latency communications, IoT networks. These are all going to be big money makers. It's just no one's really fleshed out the software side of things, and no one really has an idea of how to deploy this on a large scale.
And Keith, I've been doing a lot of reporting on India and the opportunity there for media companies due to the expansion of 5G. So when you're looking at the international rollout of 5G, are there certain regions that you think could benefit more amid greater 5G adoption?
Yeah, I mean, you spoke to India. That's an area that, when you look at like the Nokias and Ericssons of the world, that's a big aspect of their business right now, is getting these networks rolled out in the developing nations. Established nations, the US, Canada, China, they already have been rolling out 5G more or less at the same pace. But there's still a huge underserved market, especially in India, that we're seeing. I mean, that country alone, they're still finishing 4G networks. So 5G is, while they're starting to roll it out, it's still kind of on the horizon. Especially, as we look to a way to monetize it. But yeah, so these are, big countries that have a huge opportunity for revenue. It's just, I think the US is going to be the test bed for a lot of these cool new technologies. And it's just, we haven't seen them come out yet in any meaningful way.
And Keith, let's dig into some names here for viewers. Looking at your list here, you got a positive outlook, you said, for T-Mobile, for Verizon, for AT&T as well. How come, Keith? Kind of walk us through why you're positive on those names.
So I'm very positive on T-Mobile. We have a strong buy opinion on them right now. They're leading the pack in terms of 5G. They're leading the pack in terms of the next generation of 5G, which is the 5G standalone standard. And that's where the enterprise money is going to start to flow in. AT&T, we actually have a hold opinion on right now. They had a lot going on in terms of, the Time Warner deal set them back a few years. And, the debt load is not exactly looking great for that company. And Verizon, we actually have a sell on. We think they're more or less dead last in 5G rollouts. They more or less bet the farm on millimeter wave, which is really, really fast, but it's really hard to propagate that signal to consumers, especially in urban environments. And so they had to step back. They bought a lot of mid-band spectrum, which is really, really valuable during the C-band auction. And so we see them more or less 12 to 18 months behind T-Mobile in terms of their 5G rollout. And so T-Mobile has a great first mover advantage. AT&T is, kind of bringing up the next second place position, and Verizon's kind of in a third place position, and, Dish is well behind, EchoStar now is well behind the other three in terms of network rollouts.
All right, well, we'll be keeping our eye on some of those names. Keith Snyder, thank you so much for joining us.
Of course.
Well, don't go anywhere. There's more Yahoo Finance on the other side of this break. Cash bonuses fell across Wall Street during a challenging 2023, but for some top executives, they were able to buck the trend. Here are the details is Yahoo Finance's David Hollerith. Hey, David, what'd you find?
Hey, Ali. So a report today from the New York State's comptroller found that on average, Wall Street bonuses were down about 2%. And that's important because the reasons are cited are market volatility and an influx of younger workers who pulled down the average. But to your point, as you pointed out, for a number of CEOs of major Wall Street banks actually rose last year. Some of the biggest banks' cash bonus payouts were up for CEOs of Goldman Sachs, Morgan Stanley, Citigroup, Wells Fargo, JP Morgan Chase, and Bank of America, the two largest banks, their CEOs. Jamie
Hey, David, I think we're, sorry to interrupt you. I think we're having some audio issues there. We're trying to get that fixed up and bring you back. Moving on here quickly, Shell out with an announcement that it will be transitioning to improving its place in the EV market and shrinking its retail footprint, which may come as a surprise. Let's bring in Yahoo Finance's very impressed Iranian to give us the details. Surprise?
Well, I mean, I was a little surprised to see that they were kind of reducing their footprint by, 1,000 stores in the next 2 years, or retail locations as they call it. It was kind of buried in their energy transition report, but I think it may make sense because they might be, with their EV charging, they want to expand the number of plugs they have from 54,000 to 200,000 across the globe. They want to focus on China and Europe where those markets are demanding that. But I think the way they might operate this is, you close some of these locations that are sort of poor performing or just not the best spots, and you add more plugs in current locations. You add more plugs, like they said, in sort of mobility spots like restaurants. Grocery stores and coffee shops. And then potentially, maybe you open new facilities that have these charging locations. And they talk about how we have great spots because people come there, they can get coffee, they can get convenience store items, and they can charge up. So I think they think they're in the right spot there for that EV boom that they still see happening.
Listen, I'm a Wawa girl from right outside the Philly area. You can get a hoagie, you can charge your car, you can get your gas. So that's, now that I think about it, I guess that makes sense. Are there other traditional gas companies that are doing things like this?
Well, you mentioned Wawa. I was at one in New Jersey a few weeks ago, and that's where they had a Tesla supercharger location right there. So you could fill up there. You can charge it up there, go inside, get your coffee, get your sub, get your hoagie, that sort of thing. I mentioned BP has a deal with travel centers. They also see that as a kind of a mutually beneficial relationship. And I think the big issue here is downtime. They don't want downtime. You spend a couple $100,000 on a charger, and if you only have 5 people using it in a day, it's not worth it. So they want to have consistent people like you and I going there. Fleet operators is a huge deal. So they want to have those corridors sort of lined up across the country. And I think that's the big bet is, can they get enough volume to make it work?
Yeah. When Shell says, by the way, it's going to divest these 1,000 retail sites, internationally, do we have a breakdown there? That's China, that's Europe?
They didn't say where they're going to divest them, but they have 47,000 locations across the globe. So 1,000 units gone is about 2% of their locations. So not that much, but that's still 1,000 locations. But also 47,000 across the globe is kind of impressive, right? So that's a big footprint.
All right, I want to run that video of you charging your, look at the form.
That was a cold day. It was a cold day. Let me tell you.
Were you test driving something in that video?
Well, we were we were actually testing out the new adapter that Ford has that you can use to access the Tesla supercharging network. So you plug it in, pop that thing in, and it immediately starts charging. Very convenient, very simple. Yeah.
I love the action shot.
There you go.
Action shot, he has the sunglasses on.
It was a sunny, cold day.
I love it. I love it.
Producer, reporter.
He does it all, man.
Yeah. Oh, man. Thank you, Bryce.
Yeah.
Appreciate it. Coming up, KB Home set to report first quarter results after the close. On Wednesday, we're going to take a look at what to expect on the other side.
Yahoo Finance's Wealth is your guide, your group of advisors, planners, and jargon busters to help you save, build, and grow your money. How do I know if I'm saving enough for retirement? How do I know if it's right for me to go on that lavish vacation? Is it finally time to refinance my mortgage? How do I pay less in taxes? We'll get you the answers you need. Wealth earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. Wealth cuts through the noise to help guide your financial decisions so that your money works for you. Wealth on Yahoo Finance premieres March 25th.
A spotlight on housing today as fresh data showed a rebound in housing starts for the month of February. This coming ahead of first quarter results from KB Home, reporting after the market close on Wednesday. Here with more on what to expect is Yahoo Finance's Danny Romero. So Danny, what are you watching for tomorrow's report?
Wall Street is expecting that this quarter be a lot softer than the last quarter. They're really, and one of the areas is the homes delivered. They're expecting that area to really be lower. They're expecting that to land around 3,000 homes delivered for this first quarter of this year. And if we compare that to the fourth quarter last year, homes delivered were dropped about 10% to around 3,400 homes. Meanwhile, analysts are really expecting net orders to climb to over 3,000, and that's well over last quarter's results. So that really does show that their home builders are enticing. They're expecting that, that to continue to offer those juicy incentives, which they have been, to entice buyers back into the market. Some of those incentives have been the mortgage rate buy downs, which means that the builder upfronts the cost to lower the rate on the loan. bottom line, the new home market is still outperforming the existing home market. And, we just got fresh data out today that really does show that housing starts for both single family and multifamily jumped nearly 11% last month. So that really was the strongest gain since last year, really driven by the single family starts. So really another sign of such a positive outlook for the new home market at the end of the day.
What distinguishes KB Home, Dan, we were talking about this, between in the new home market, what's their focus as opposed to Toll or DR Horton?
Yeah, they are focused on build to order aspect, and they're really trying to capture the first time home buyer, which is why those incentives keep enticing buyers into the market, because they're really trying to capture that demographic at the end of the day who are dealing with the affordability issue.
Yeah, for sure. Danny, thanks so much. We'll be watching. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.